But we're very pleased to have joining us Stuart Vaeth, Senior Vice President of Strategic Business Development for Trua, Brandon Schuh, Head of Specialty Insurance at the Christensen Group, Nicholas Johnson, Director of Public Policy at Lyft, and our moderator, Keerthi. I can't even read my own handwriting, Keerthi. I wrote this down in 10, 20 seconds. But she is a technology reporter at the Los Angeles Business Journal. Keerthi, please. Thank you.
Okay, everyone. So my name is Keerthi Vedantam. I'm a tech reporter at the Los Angeles Business Journal. We're going to be talking about safety, security, insurance risk, and I actually feel like this is a pretty interesting topic just because whenever there's like a new industry or a new sector that's on the rise, at a certain point you have to deal with all the ancillary issues, and these are sort of the kinks that need to be worked out in order for companies to be able to budget scaling, to be able to budget innovation. So I'm really excited to chat about this. I will have everyone kind of introduce themselves and say a little bit about what they do. Do you want to start, Stu?
Hi everyone, Stu Vaeth. I run business development at Trua. Trua provides identity verification and continuous background screening with a focus on privacy, control, and transparency for the end user, such as a gig worker or delivery driver in this context.
Hey everybody, Nick Johnson, Public Policy at Lyft. I think you all know what we do. I am the Director of Public Policy for the West Coast, so my coverage includes California, the Pacific Northwest, Southwest, basically everything from Alaska to Colorado.
And I'm Brandon Schuh. I'm at Christensen Group, Minneapolis-based insurance brokerage, and my team focuses on specialty insurance and the shared and digital economy.
Okay, great. Brandon, I do want to start with you. The shared economy is just inherently very complicated. There are a lot of assets. They belong to a variety of different entities. They all need to work together. How does the Christensen Group kind of go about figuring out how to regulate or predict what insurance premiums are going to look like for every niche new thing that comes out, like a robot, a gig driver, a drone, whatever it is? How do you guys go about doing that?
Sure. So I'll start out with a story. So 2 or 3 weeks ago, the most watched video in the world was a new flying car that demoed, and they showed the flying car lifting up over another car and then setting itself back down, and it had about 2 billion views within whatever it was, 24, 48 hours. So I actually did I did a news story kind of in terms of the reaction to it, but that's a great example of something that the technology is far outpacing a lot of the other regulatory insurance hurdles. I mean, there's no way right now to really insure that vehicle. If you wanted to drive it on the road, we wouldn't have a solution. But since the shared economy kind of exploded in 2017, 2018, I would say insurance departments now, and there's a few of them out here in the audience who represent those, have become armed and equipped to figure out how to quickly harmonize with the risk. So autonomous is a great example of something we still don't really have maybe our arms around. Autonomous is it's an automobile, but it has a product integration that's substituting out the negligence aspect of driving. So no longer are you blaming a driver for what happens on the road. Now, who do you blame it on? Is that product liability? Is it cyber liability if there's some sort of manipulation of the data or the firmware or whatever it might be? So there's a lot to think about, and even right now, it might not be fully understood how those policies will respond.
Nick, given that you do a lot of stuff on the public policy side, Lyft was, one of the first movers in the driver space, and then some companies, there's scooters involved now where there's no driver at all. In fact, there's just the person, the consumer themselves. How does Lyft go about, I guess I'm thinking about when we're thinking, as a company, what's the next thing we want to do? What is, the next way we want to improve our company? We want to scale. We want to improve our bottom line. Your job as someone who works in public policy is working very closely with California and kind of figuring out the kinks. Can you talk about maybe what some of those conversations look like for you when your boss gives you this sort of hey, bad news, buddy, we've got a new product in the works?
Yeah, the first thing is to just not say no. You can't do that, and try to figure out a way or a pathway to success there. And I actually like the term you came up with, not came up with, but what you said before about some things being ancillary at the very beginning. And my job is kind of figure out what's going to be ancillary now, but will be very real later. And to your point about insurance and insuring emerging risk, right? Insurance for rideshare was ancillary when the statutory requirements were made almost a decade ago, right? California being the first, obviously, we're the first in a lot of different things, right? And that was the first time we did it. And at that time, it was darts on a board, trying to figure out how to best right-size this risk for, going into a stranger's car or going into, a black car at the time for Uber. So there was not a lot of data out there. And now, after 10 years, there is some data, and maybe those requirements weren't right? And so I think learning from that situation in which, we're going pretty much across the country trying to right-size the risk statutorily, I think from that situation now, if we're coming up with a new product or a new way of transporting people, we're thinking about those ancillary things. So we're thinking about everything, so that when it becomes real, we can handle it, right?
I'm going to return the compliment. I like right-sizing risk.
I've been working it out, so.
Okay, patent that. Stu, can you tell me a little bit about what your company does? And, when I think about right-sizing risk, to Nick's point, there's just a lot of data that needs to be collected that sometimes was not possible to collect. Now it's a little bit hard to collect. Can you tell me a little bit about what your company does and sort of how we can again, scale, understand what risk is going to look like in the future?
Sure. So rather than take a company perspective, I'll think about the market and kind of the society that we're in, right? I think we are moving more and more into a completely data-driven society, right? Data is so fundamental to all kinds of decisioning. But we still have a huge amount of data that is centralized, that is stored all over the place, right? Too much data being stored, it results in hacks. It's, subject to surveillance, deportation, all the risks are associated with centralized data. It's just bad. So the movement globally, right, is to have more decentralized data, including personal data, identity data. So the EU is leading, and several other countries are leading around decentralized identity. Forbes just put out an article today about this whole topic, self-sovereign, having control over your data, right? Rather than just giving your data to every place and it's stored all over the place, you own it, it's in your wallet. It can be in, California's got mobile driver's license now. They've issued almost 1 million of them. You can put it in a California app if you want, or you can put it in your Apple or Google, your platform app or other party apps. So that's the start of it. It's just, I am who I say I am. It's my driver's license that's decentralized that I have control over with disclosure, right? With very controlled disclosure, selective disclosure if I only want to give out my age for things. Now build on that, and this is where Trua comes in. We're using identity, we're providing identity, but that's not our focus or differentiation. We're focusing on layering on background screens for safety, right? But now giving it to control and in the hands of the end user, say a gig worker. So now imagine having a continuous background screen that I don't have to do every time I go and do a new gig. I have it in my wallet. It's dynamic, it's continuously updated. I share that. I share selectively. Oh, you want to know I have a clean criminal record? Here it is with my identity. So it's adding another layer of dynamic data under your control. And it just provides much more freedom, transparency, better accuracy actually, because it's first-party data, right? So now, we're trying to move from third-party data. It starts with cookies and all that, but just moving towards first-party data, meaning I've verified it. So as a gig worker, I can receive my background, verify it. If I have a problem, I can dispute it with Trua. Say, yep, that's a false positive, whatever. Then you can share that. It's under your control. It's better data. It's more accurate.
Interesting. I'm curious about going back to the flying car, right? Like, what kind of data, maybe that's not a good example. What kind of data do you have to collect in order to be able to predict what premiums are going to look like for something that's like a neighbor of what already exists, like something that's new but kind of similar to this other thing?
Sure. So I'd say one of the biggest new technologies or new growth that we see for business coming in is like vehicle leasing models. So whether it's low-speed electric, whether it's a normal car, maybe it's like similar to like VGM supplying cars to Uber or Lyft or somebody like that. The barrier is oftentimes the fact that there's a separation or one standard deviation apart from the leasing company, the one that buys the insurance, to the operator or to the driver who drives the car. So it's oftentimes, as Trua, as you just mentioned, there might be this kind of break in data where I, as the leasing company, might not have access to the driver's data. So how do I credentialize the fact that they're a good driver when I have no direct communication with him, because there's a Uber or Lyft in between us. So the vehicle leasing strategies are complicated because unless they have really good protections in place or vendor contracts in place to make sure that you're passing on or transferring the risk down the contractual line, it can be challenging. But that's a data that we need. We need to know if somebody's credentialized with driving data, motor vehicle record checks, background checks. Now you're seeing more and more companies pop up that want to transport children, like bus alternatives or senior living alternatives where, they might be more susceptible or more, there's less guards in place to prevent a data theft or data manipulation of some kind in terms of passengers. So how do you protect that? But as a vehicle leasing company, it might be really hard to distill or fine-tune how you collect that data.
What was it like with the early days of Uber and Lyft, like kind of those first movers who came in? How did insurance companies deal with like a rideshare? And everyone can feel free to jump in here based on what they know, but I am curious about the maybe history of that.
Yeah, I mean, we have some insight into it just because there's a lot of like anecdotal stories that are traded. I wasn't involved in that early trading. You might have had more insight, but a lot of new policies that are written, at least historically, are written on the basis of we don't know the risk, so we're going to price it a lot less maybe than we otherwise would have. So Uber, for instance, was priced at a certain policy probably based on number of vehicles or something at the time before we used more usage-based tracking methodologies. So, well, maybe this looks good. Well, it turns out it wasn't good, and the amount of claims activity far superseded the amount of premium that was collected. It's what we call a loss, kind of a loss ratio or a combined ratio evaluates that number, and it's so hard to figure out when you're early on in a space what the risk actually is going to look like. We didn't know that Uber and Lyft were going to just blow up in terms of usage. You take it over.
Yeah, well, I wasn't here either during that time, but from what I know, from what I've talked to our internal risk folks and the people who were around, it's just as you said, and as I said earlier, I mean, quite pejorative to say darts on a board, but number of vehicles, number of drivers, number of accidents, and then the data has just gotten better and better over time so that they could price the risk, right? And so, but then there's also other things like, is it livery? Is it, a personal vehicle? What is the what is the person who has that personal vehicle, what kind of insurance do they have, right? In California, which is kind of unique, drivers have occupational accident insurance, right? And so how does that play into it? UM/UIM insurance, how does that play into it? So the data has just gotten better over time, but I think as any industry that starts, you're kind of guessing, right? And so, the way we do it, and we share this with the insurance companies, we have actuaries in-house that, try to make the case for what our premium should be and what our risk should be. I'm not sure how Uber does it, but I'm pretty sure we didn't have that capability at the very beginning. I mean, we saw that it was important to do that.
Is there a sense that there may have been like an overcorrection when it comes to what Lyft is liable for in the insurance marketplace? And I only ask, in the housing economy, for instance, like all these fires happened, right? Now there's this question of like, were things priced too low? Did we make people pay less than they should have? What should have happened instead? And I'm curious to know if that's something you've reckoned with, just, in the world of insurance in general,
Yeah, I wouldn't even say the price, but more of the limits.
Oh, okay.
And were the limits appropriate? So right after California passed insurance requirements for TNCs, Incoil came out with a model that was completely different than what California had did. Now, that's
Sorry,
not
wait, who came up with this model?
Incoil, the National Conference of Insurance. Something.
All right, cool.
But they said model legislation regarding insurance. And so after California had came up with their bill, they said, okay, this should be the model bill for TNCs. And it wasn't that close to California. And again, this is California, so this is not necessarily, a change, right? But one of the things that was missing was uninsured, underinsured motorist coverage. And California, we're required to have $1 million, and in about 30 odd states, we're required to not have it at all, or it's optional, right? And so if you're looking at that, well, what has that done over time? In California, as a personal, on a personal vehicle, you're required to have 30/60, right? 30 per person, 60 per accident. Well, how does that equate to 1 million, right, for rideshare, where in Lyft, where people are using their personal vehicles, we don't have a fleet, right? Or not yet, but we didn't have a fleet during this entire time. And so I think, back to your question, we just didn't have enough information at the time to set the right limits. And I think there needs to be a correction. I don't know if there needs to be an overcorrection, but there needs to be a correction, again, right sizing of what limits are appropriate to not only just make sure that people get what they need when they've been in an accident, right? But also not have an industry, as uninsured, underinsured motorist coverage goes right now. How we see it is that we subsidize the roads in California when it comes to that insurance.
This is maybe a question for both of you. Obviously, anyone's free to jump in, but I guess to your point, how does, if there isn't a correction, right, what are the tangible effects on how Lyft is able to operate, the effects on the end consumer, and also the driver? Like, what are the ripple effects of this sort of policy?
Well, prices just will continue to go up, right? And we have to pay our insurance premiums to nice guys like this, and then we have to make sure that we budget for the amount of claims activity that we see. And if you have large limits, I'm sorry, but you're going to be a target for attorneys, right? I'm a former attorney myself, I would do it, right? And so if I know that you're statutorily required to have $1 million in uninsured motorist coverage or auto liability, and I'm gonna try to get every cent of that $1 million, right? And so that makes us less of a target. It deters frivolous lawsuits, and you could see the prices come down, and then you could see the drivers earn more. And that's what we're trying to do. It's a marketplace, right? And our marketplace is very sensitive to these external costs, whether it's taxes and fees, and whether it's insurance. And so if we're able to reduce those limits and right size those limits, then you could see that prices either stabilize or go down.
And there's a counter kind of pressure that's being applied right now on the industry, which is the cost of vehicles themselves. Especially when we're talking about, use a Waymo, for instance. I don't know what the number is, but Waymo spends $180,000 or whatever it is to outfit the vehicles with the technology to drive it effectively. So that's obviously a very expensive collision if it happens. But now we have sensors in every vehicle. Those are more expensive. It's $15,000 to repair a bumper, where it used to be $1,500 or something like that. And now, obviously, something everybody's tuned into in the last 2 weeks, we have, depending on the country you're importing from, very large tariff changes to the cost of goods, which will also have an inflationary impact on your insurance policy. Because if it costs $15,000 yesterday to replace a bumper, and you're bringing in parts from China, maybe it's $30,000 to replace that bumper now. That's hyperbolic a little bit, but it's what we're looking at depending on what country we're importing from.
And I would just add that, he talked about the tariffs and how that could impact as well, is that, there's also macro elements to, our insurance costs that are unrelated to the accidents that our drivers have or the amount of vehicles that we have on the platform. I mean, everyone knows in California that the insurance crisis is real, and it doesn't just impact home insurance, but it has its trickle effects down to auto liability as well. So that raises the prices from, regardless of anything that we do, good or bad.
It seems like there's a lot of crossover with insurability and risk, obviously, and safety and trust in the marketplace. Safety with the drivers, safety with all kinds of things, right? How you manage. And we just did a national survey of consumer perception of trust and safety across all marketplaces, not specific to driving, rideshare, but one of the stats that came back was that 86% of the consumers said a major factor in their decision about a marketplace is trust and safety reputation. How good do they do it? What am I reading? Is it really trusted? What kind of safety precautions are doing? And that obviously helps with insurability too. If you're taking those steps proactively, if you're doing continuous verifications of time, background checks is just one thing, but anything you're doing continuous, you're going to reduce your risk of exposure.
Yeah, and I mean, it's a basic element of our business, of the sharing economy, right? If you don't have trust and safety, I mean, 10, 11 years ago, nobody would have thought you would go into a stranger's car to go to the airport or go into someone's home with your family for a
I was
week.
so scared when my freshman year roommate did that. I never heard of Uber before.
Yeah.
I was so scared of her when she did that.
But now it's
Yeah.
it's ubiquitous, right? And it all starts with trust and safety, right? And it's a part of the value proposition, and it's what makes people want to use your platform or your marketplace.
Stu, are you allowed to talk about some of your clients and what they would use something like this for?
So dating apps are an interesting case, right? Where trust and safety is very relevant. And there have been lots of issues, right, with safety. And I mean, Match.com was in the news this year around,
Oh, that markup story. It's really good if you guys want to read it.
So, surprising to me, and maybe everybody I talked to was like, oh, I'd pay for a back. In fact, in the survey, 60% of people said I'd be willing to pay for background screening to feel safer, right? Mm-hmm. It's not that expensive in the scheme of things, right? If you're going to go date somebody. But at most, these platforms are making it optional, right? I can, not all, I can get a background screen and put it on my profile. I'm verified, but it's optional. We're working with one that's going to launch this year that's going to make it table stakes, right? Be on this platform, you're going to be screened continuously. It's not 100%, nothing's 100% perfect, but it raises the bar around safety for a marketplace to do that.
Yeah, I find companies like yours to be really interesting in this whole process because in this domino effect of, new sector, insurance, like all these things, then you guys start to become the new sector, actually. Like the standardization of trust and safety ends up becoming like, well, we could use it for something like driving, we could use it for dating apps, we could use it for all sorts of things. And I always find that to be very fascinating, the evolution and life cycle of startups in the tech industry.
Yeah, the reuse component is, I mean, just imagine if you're a gig worker and you're doing all these different jobs of various types. You might just be a driver on lots of different platforms, or you might do lots of things, right? Wouldn't it be great if I could have a credential that I could just do one verification, right? Which is the expensive, economically it's a great thing too, but from a gig worker perspective, I do it once and I can share it over and over again under my control, simplifies my life. And from a cost model, the cost of doing a background screen is heavy up front to do all the court records check. Monitoring it continuously is very low cost. So it actually, at a macroeconomic level, it's just much more cost effective to say, give me a credential, a background screen, and then monitor it that I can share and reuse. I think it's the right way to move. It's going to take some time to get there, but.
Between you, what would it take for an insurance company to adopt something like this, or to require this be standard for any sort of industry? I'm thinking, I used to be a healthcare reporter, and there are a lot of health startups that, they would rather go the benefits route with companies rather than start with insurance because, insurance needs a ton of data. I'm curious to know about where something like this falls in here when it comes to trust and safety.
Go ahead.
I can start. It's an interesting question because everybody thinks about it. Everybody thinks how, especially the technology providers that are doing it, how can we partner? And I think there's a lot of that happens. There's a lot of collaboration that happens. But the problem with enforcing anything in the insurance space is it becomes friction with your carrier partner. Anytime that you're saying you have to do this, it's another piece of friction that comes into the mix. So, there are, I think safety in general is much more effective when it's ground up instead of top down. So, I know it's been recorded many times over the industrial safety environments. It's the safety starts at the top. Well, it really maybe doesn't as much as people think. How do you get your employee base, your users, your drivers engaged in safety? Now, whether that's through gamification of some kind. I know UPS has challenges and rewards. I mean, think about how you compensate someone in sales. You compensate them with money. So how do you do that same thing in safety and data and behavioral changes in real time? It's probably from the ground up, not the top down, is generally how I see it, because it's very hard to say you need to work with this person in order to provide this quote. There are partnerships that happen and maybe discounts that happen, but I think it's much more effective ground up.
Yeah, I agree. I mean, I'm not an insurance guy. I know in digital identity, I've worked in this for 10 plus years, just in reusable identity. And we were talking to a bunch of insurance companies about insuring the identity, right? In other words, so that a relying party, a merchant or anybody that's a bank that's relying on this identity could actually, if it's not correct, because nothing's 100%, so there's a risk, right? Say we did a really strong job of verifying your identity, biometric, da-da-da, but there's always, advanced attack, so there's never 100%. So, we were working through models to ensure the identity as you pay more because there's a cost to that, but you could charge more, but now there's a coverage to say, hey, I'm minimizing our risk if I'm relying on that identity, I've got an insurance-backed identity, which is an interesting business model. So it's a way of doing it without mandating it, to offer it as a value-added option. You want an insured identity.
Oh, interesting.
Pay a little more.
Right.
And you've got coverage. You're lowering your risk.
It's like smoking cigarettes on a benefits package. It's hard to say I'm going to reduce maybe your rate because you don't smoke, but it's easier to say you're going to pay more if you do. So it's kind of that reverse engineering thought process.
Interesting. Are there any, because again, I find your sector to be among the newest. PitchBook has called it one of the emerging sectors, digital identification, verification. for 2024 at least. I don't know what's going on this year. What are some of the bottlenecks to a company like yours being able to do what it does?
Yeah, I mean, we're small, right? So it's brand, right? So I do partnerships, right? Partner up with bigger companies that can bring us, combine what we do to other things they're doing to bring it to the market. So that's a barrier. It's being small and, who is Trua, right? So we've been around, done a lot for government TSA, but partnering out with companies that have brand, especially if you're going out to consumer, like we're too small to go direct to consumer. So that's a challenge. So we partner with companies that have a consumer brand and a trusted brand, they can bring this to their base. I was at MasterCard for 6 years. We spent millions of dollars trying to create a reusable global identity network, right? Carrying identity, launched it in Australia and Brazil, got great uptake, but the company decided we changed CEOs, they backed off it, it's kind of stalled.
Interesting.
And, it could have been a great thing, but creating a big multi-sided network for something like this, because you need to create the acceptance and the issuance, right?
Right.
And solve both sides at the same time. It's like starting a car marketplace, right? Got to solve it together. And we did it in a couple countries, but it takes a lot of money and a lot of marketing. And
I'm shocked that MasterCard kind of flipped the switch on that.
it stalled it. It's still, they invested in some other things. It's going to happen. I mean, the EU is driving it from a regulatory perspective. It's going to take a while, but the EU is definitely driving, mandating decentralized identities, wallets. So there's a whole bunch of companies participating in that. U.S. is a little behind on that. Having U.S. government's not going to do anything from an identity perspective. At a state level, absolutely. Mobile driver's licenses, they'll get picked up, and that's a good thing. But at a federal level, no.
Yeah, no, I feel that. I guess I'm curious, since it is kind of small here, does anyone have any questions for our panelists? Yeah, go ahead. If you could maybe also speak loudly.
I am a driver, and I keep a spreadsheet of every single trip on Uber's Lyft, and I break it down into the fare. One thing I've noticed, Lyft in particular, their insurance rate per mile averages about $1.29. For Uber, it varies from 80 cents a mile to $6.87 a mile. There's no give or take. I've done over 14,000 trips, no accidents, tippet carjacking, not settled with Lyft yet. And other issues. So I've been a safe driver. I worked at drug group in the university towards town. Yet it would be cheaper for me to buy my own $1 million policy than to continue with regular insurance. Because there's no standard like per mile rate. And the deductible for drivers in an accident went from $500 to $1,000 to $1,500, and then go to $2,000, probably in the next 6 months per year. So at what point do we actually insure the driver and the passenger and bring those costs down, or allow us drivers to buy our own $1 million policy and take that risk versus how much you guys are getting?
Yeah, so I would say, first of all, you're absolutely right, and it's going to get worse because the insurance market is nowhere to being settled in California, and it's going to be, I think we average about, to your point, you did on a per mile, but on a per ride, the average is $6 per ride
Oh my God.
in California, right? And this is not an arbitrary cost. These are costs that have to go to running the business, whether it's anticipating the claims count that we get in one of our biggest markets, Los Angeles, where we see a ton of claims, and then also for premiums as well. And so, yeah, you're right. Like it is a lot, but we have to pay for it because we're required. Now, for drivers, you're covered through the occupational accident insurance that we have, which is $1 million. And then I'm not going to get into the minutia of P1, P2, P3, but when a driver's in a vehicle by themselves and when a driver has a passenger, when they have a passenger, if we are at fault, or if the driver is at fault, I should say, then we have a $1 million policy, regardless of the statutory requirements. And so where it becomes an issue, again, I hate to harp on it, but it's with the uninsured, underinsured motorist coverage, which is at $1 million. And half of the costs per ride for insurance goes to that. And those are claims where we're not even at fault. a third party is at fault. And we have to cover the claims that are caused by another party. And so if you look at the data that we have, when our drivers are liable, those claims average out at about 50,000 or less, right? But they're not 50,000 or less when it comes to uninsured motorist claim coverage when we're not at fault. So you see where the disconnect is there, right? And so, when it comes to drivers making more and rides costing less, you are absolutely right. Like, a lot goes to insurance, and I hate to say it, but it's going to get worse unless we do something about it.
I would jump in too and say, you mentioned you could go buy a policy for less somewhere else. So what happens right now is whoever you're using for a policy, Progressive, State Farm, whoever it is, they know that when you're on the clock, their policy kicks in. So there's different coverages, like you said, period 1, 2, 3. But if your carrier knew that they had to take the burden for all claims when you're driving passengers around, number one, they won't do it. Number two, it would cost way more money. So what they benefit from is scale, right? Because they are insuring all their platform. So in relativity, his is still going to be way less than you could get on an individual basis in the market because he's buying for his whole fleet, whereas you're buying individually using the same limit. So it's a problem, don't get me wrong, regardless of how you slice it, but it's still probably the most equitable way to do it as it's positioned right now.
Yeah, I would say that you probably don't want to get into this market to buy that type of insurance or individually. Yeah.
And in California, you guys have $1 million, so I've looked at it.
Mm-hmm.
It cost me under $1,000 to have $1 million policy because of my driving record, because I drive 50,000 miles a year with no accidents.
Right.
Like, I would consider myself a safe driver. It is the uninsured, it is the other people. That is it. To me, it doesn't make sense of, it ought to be like a flat fee per mile versus it varies so much. And then as drivers, we get penalized and the deductible is like it's California, but at some point,
I would bring you to Sacramento to say exactly this. Like, we actually need to say this.
Thank you, I appreciate your time.
Yeah, go for it.
Speak up.
I can get my own commercial policy, which covers me for P1, P2, P3 a lot better than what you're offering me, because as we know, there's no P1 coverage. Zero.
Well, there is P1 coverage, but it's low because the risk is low. It's 5,100 because the risk is low because that's when you could be sitting in a car not driving, right? Yeah. So exactly. I haven't heard anything, but let's talk after because I'd like to hear what you're seeing out there from Uber.
And the deductible part, right, which is $2,500 now on both platforms, I think
Right.
cut it down too. A lot of drivers that I do talk to, they are foregoing and getting their own commercial insurance. In fact, I did price one for myself. It came to about $1,100. And if I'm a full-time driver, and if there's a dollar subsidy or credit, let's say, for each P3 mile, as a full-time driver, I am definitely driving probably 1,000 P3 miles a week. It makes a lot of sense to give the choice, at least to the driver community, to make more money that way, get their own insurance and have better P1, P2 coverage, kill two birds with one stone.
Yeah, but I think, and I appreciate that, and I think that That's honestly a good idea, but I think what my friend to the side here said, it's scale, right? Where we have a few drivers doing that, it might be one thing, but that price might go up if we have 1,000 drivers doing it, or 15, because that's the way the market works, right? And I don't think it's a matter of if it's Lyft or Uber or DoorDash or Instacart, right? I think it's the matter of the insurance market in California being as volatile and particularly crazy as it is that if that becomes more at scale, then it's going to start to cost you more. And so let's talk afterwards.
Yeah, actually, we do have to wrap up. I am curious, though, how many people here are drivers? Okay, cool. Good to know for me. Thanks so much for doing this, everyone. I really appreciate it. I think this was a really interesting conversation. There are just so many moving parts to something like this. There's a lot of state regulations, federal regulations, what information can be shared, what kind of data is actually useful for insurance companies. So I really appreciate you all talking about this. Thank you so much.
Thank you.
Thank you.
Thanks.
Round of applause.